Welcome to the deep dive. Today we're looking at a real giant in global healthcare. It's a company that's kind of managing two completely different realities, almost side by side.
Yes, that's a good way to put it.
On one hand, you've got this incredible, cutting-edge innovation in medical devices. We're talking really next-gen stuff like leadless pacemakers, specialized heart clips, really soaring.
Right. High growth, high tech.
But then on the other hand, there's this significant financial hangover from the whole COVID-19 testing boom. Necessary, maybe, but definitely painful financially.
And that company, that duality, is Abbott Laboratories, ticker ABT. Look, for you, the learner, trying to really get a handle on ABT's value, its trajectory, it could be pretty complex.
It's not simple, is it?
Not at all. It's basically four different businesses rolled into one. Our source material today, though, it's this really comprehensive investment analysis. It cuts through, the headline noise. It really shows the engine driving this company.
So our mission today is exactly that. Cut through the complexity. We want to pinpoint where the real reliable growth is coming from. What's the motor? And how well have they actually pivoted away from those temporary pandemic revenues?
We'll need to break down those four segments, see how they fit together.
Exactly. And then look at the arguments, the bull case versus the bear case, for what the future holds for this huge organization.
And structure is key here. Because if you just, glance at the top-line revenue from the last couple of years, it can be seriously misleading.
Right.
Our goal is to find those strategic aha moments, the things that show the underlying strength, to prove the business is actually much healthier than a simple chart might suggest.
Okay, let's tackle that big transition right away then. The whole operating environment just fundamentally shifted after 2022, didn't it?
Completely.
Everyone knew those huge high-margin COVID test sales, they weren't sustainable, just a temporary spike. But when that revenue finally dropped off, wow, it left a massive hole in the main financial numbers.
And that's exactly why you need to dig deeper. I mean, if you only look at the reported sales for fiscal 2023, total revenue actually declined 8.1%.
Yeah, that looks bad on the surface.
It looks concerning, right? But analysts and, importantly, the company itself, they saw that decline coming. It was pretty much all driven by the rapid drop in testing demand as things normalized. It wasn't, a sign the company was failing. It was just the cost of getting back to normal.
Okay, but here's the crucial counterpoint. And this is where it gets really interesting if you're trying to figure out how healthy the core business actually is.
Right.
If you filter out all that noise from the COVID tests, the underlying base business, it saw incredible organic sales growth. We're talking 11.6% in 2023.
At 11.6%, that's resilience, plain and simple. It shows the non-COVID parts of the business were incredibly strong, performing really well.
Strong enough to almost cancel out that huge drop from diagnostics.
Exactly. To pull off double-digit organic growth in your base business while dealing with that kind of headwind. That's pretty rare for a company this size. A real achievement.
And that momentum kept going, right? Fiscal year 2024, the base business grew strongly again, 9.6% organically.
Which let them get back to reported top-line growth overall. They hit $41.95 billion in total sales for 2024.
So it really signals that the pivot, the move to the post-pandemic normal, it worked. The underlying growth engine is still there, and it's running hot.
And they don't expect it to cool down. Looking ahead, management guidance is, it's very positive. They're projecting strong base business growth, aiming for 7.5% to 8.0% organically, excluding COVID, for the full year 2025.
That shows real confidence, doesn't it, that the volatility is mostly behind them?
Yeah, they believe they can focus now on consistent, high single-digit growth in their core markets.
Which brings us back to how they're structured, right? The importance of those four pillars of diversification. A lot of their competitors are really specialized, but Abbott's segments, medical devices, diagnostics, established pharma, nutrition, they're not just random pieces.
No, they're strategically designed. It's about balancing risk and opportunity. You get the high growth, the innovation drivers in medical devices. Diagnostics is, it's undergoing its own strategic shift right now.
We'll get into that.
And then you have the stability, the reliable cash generation from established pharma, EPD, and nutrition. That structure is basically their insurance policy. It's built to handle exactly this kind of volatility and keep funding future innovation.
Okay, so if the whole company is this ship navigating choppy waters, medical devices is the big, powerful new engine pushing it forward.
Absolutely. That's clearly their main growth engine now. It's their core identity for investors, for innovators. It's the biggest segment, too, bringing in what was it, $18.99 billion in sales in
Yeah.
2024.
Yeah, nearly $19 billion. dollars.
And what's really striking isn't just the size, it's the sheer consistency of its performance. I mean, massive organic growth, 13.4% in 2024.
And it's not slowing down much.
Not really. That momentum is deeply embedded. Look at Q2 2025, 12.2% organic growth. And that marked, get this, its 10th consecutive quarter of double-digit growth. Wow. 10 quarters.
For a business closing in on $20 billion a year, that kind of sustained high-speed growth is pretty much best in class in medtech.
So let's get into the specifics then. What are the platforms driving this? Because the pipeline seems incredibly deep. This is where the big money is.
It really is. You have to start with diabetes care. That's almost entirely dominated by the Freestyle Libre franchise. Continuous glucose monitoring, or CGM.
Right, the Libre.
The Libre platform was, frankly, revolutionary. It democratized CGM. It's generally cheaper, much easier to use, highly accessible compared to the older, clunkier systems.
And it's still growing incredibly fast.
Oh, yeah. Sales up 19% organically in Q2 2025. And this isn't just about stealing market share, it's actually expanding the whole market for CGM technology around the world.
And the innovation there is key, too. They're not just sticking to the traditional diabetes patients, are they?
No, that's a brilliant strategic point. They're moving beyond just type 1 and type 2 diabetics. The recent launch of Lingo, it's a really smart move.
Lingo. Okay, what's the focus there? It uses the same proven Libre platform, but it's aimed right at the general wellness consumer market. Think athletes, biohackers, anyone just trying to optimize their metabolism, sleep, energy levels.
So not strictly medical use.
Exactly. By positioning Lingo as a tool for personalized nutrition, preventative health. Abbott's tapping into a market that could be way, way bigger than traditional diabetes management. It basically turns a medical device into a high-growth consumer health wearable.
Interesting. Okay, shifting gears a bit. Structural heart. Another area where they seem to be pushing the boundaries, focusing on minimally invasive repair.
Yeah, which is critical, right? Open heart surgery is risky, long recovery time. Their main product here has been the MitraClip for repairing the mitral valve. Very successful.
But there's something newer driving growth now.
Yes, the TriClip. It got FDA approval in 2024. The big deal here is that it's the first device of its kind specifically for the tricuspid valve.
The tricuspid, why is that significant?
It's notoriously complex, that valve. It was really difficult to treat effectively with minimally invasive techniques before. So by innovating in this sort of underserved space, they get that crucial first-mover advantage.
And that's paying off.
Big time. The structural heart business grew over 20% in Q4 2024. That's not just edging up. It's a market creation, market dominance. It helps them command premium prices, get good reimbursement from insurers.
Okay, next up, electrophysiology, or EP. Treating abnormal heart rhythms like atrial fibrillation, right?
Correct. They have a solid existing portfolio there. Mapping systems, ablation catheters like flexibility, tachycardia. But the real excitement now, the focus has to be on the next-gen tech. The Volt-Pulsed Field Ablation System, PFA.
PFA, pulsed field ablation. Why is that seen as such a game changer compared to traditional ablation methods?
Okay, so traditional ablation uses either extreme heat radiofrequency or extreme cold cryoablation to basically create scars, lesions that block the faulty electrical signals in the heart. The risk, though, is collateral damage. You can accidentally harm nearby tissue, like the esophagus or pulmonary veins. PFA is different. It uses high-frequency electrical pulses to selectively target and disrupt only the heart cells causing the arrhythmia without relying on temperature extremes.
Ah, so it's more precise, less risky.
Potentially much faster, much safer. It really lowers the risk of that thermal injury. Getting the CE mark approval in Europe for the Volta system puts Abbott right at the forefront of atrial fibrillation treatment. It's a big deal.
Got it. And finally in this segment, heart failure and rhythm management, they have the HeartMate 3 pump.
Yeah, industry leader for advanced heart failure patients. Crucial device. And then there's the AVIR leadless pacemaker.
Leadless, that sounds important.
Hugely important. The AVIR approval in July 2023 was massive because it's the world's first dual-chamber leadless pacemaker.
Okay, explain the leadless part. Why does that matter so much?
Traditional pacemakers need leads, these thin wires that run through your veins into the heart chambers. And those leads, they're often the point of failure. They can break, get infected.
Ah, okay.
AVIR gets rid of the leads completely. It solves a major clinical headache and gives them a huge competitive advantage in the rhythm management market.
So yeah, the segment is clearly packed with successful, innovative products. But the question remains, how do they keep this up? How does Abbott sustain this relentless pace of innovation?
Right, and this brings us to the idea of the medical devices segment as a growth flywheel. It's like a self-sustaining system.
A flywheel. How does that work here?
Well, think about products like the Libra sensors or the structural heart clips. Once a patient has one, they generate predictable, high-margin, recurring revenue. You need replacement sensors, other disposable parts.
Okay, so it's not just a one-time sale.
Exactly. And that steady, reliable, high-quality cash flow, it becomes the fuel. It funds their massive R&D engine. They consistently pour about $2.8 to $2.9 billion back into R&D every year.
Which is about 6.5% to 7.0% of their total sales, right?
Right. A really significant, dedicated investment. And that investment churns out this steady stream of next-gen devices, the TriClip, the Volt PFA, Lingo,
Which then drives more sales, more recurring revenue.
and solidifies market leadership, expands the number of patients they can treat, ensures the revenue keeps growing. It's a classic example of a competitive advantage built on continuous, well-funded innovation. The flywheel keeps spinning faster.
Okay, let's shift gears then. Let's talk about diagnostics. You called it a strategic paradox earlier, a headwind hiding a future tailwind. The financials definitely show the headwind part. Reported sales dropped 6.5% in 2024, down to $9.34 billion, all because COVID test demand just collapsed, as expected.
That's the unavoidable headwind, yes. But here's the strategic twist, the hidden gem, the underlying base business in diagnostics. It still managed solid growth, 5.2% organically.
So even without COVID, the core lab stuff was growing.
It was. And that overall decline in reported sales, it's actually masking probably the single greatest strategic asset the pandemic inadvertently created for Abbott in this area.
Okay, explain that hidden asset. What did the frantic need for testing during the pandemic actually give them long-term?
It gave them a massively expanded installed base of their high-tech instruments. Hospitals, labs, clinics all over the world bought Abbott platforms, the Quick ID and Now W system, the big core lab Alinity systems, just to cope with the unprecedented testing demand.
Right, everyone needed those machines.
That vastly expanded global footprint of instruments is the hidden long-term asset.
Because once a lab or hospital invests, say, hundreds of thousands, maybe millions, in a big system like Alinity, they're pretty much locked in, aren't they?
Totally locked in. The switching costs are enormous. You've trained staff, integrated it into workflows. You're essentially forced to keep buying Abbott's reagents, their consumables, and crucially, their future tests that run on that machine.
So the strategy shifts now.
Precisely. That huge captive audience is now ready for monetization. It's not about selling COVID tests anymore. It's about selling the whole menu of other higher-margin non-COVID tests that run on those same installed machines. Flu tests, RSV, STIs, routine blood work, everything.
So the short-term pain of losing the COVID revenue was kind of the price of admission for this long-term advantage.
You got it. It's the necessary cost to build this incredibly durable, long-term, high-margin tailwind. It's going to be a multi-year story, converting all those instrument placements into steady, high-volume, recurring revenue from a diverse test menu.
Okay, that makes sense. Let's move to established pharmaceuticals, EPD. You called this the stability hedge earlier, the reliable engine room.
Yeah, I think of it as their structural insurance policy. This segment is interesting because it only sells branded generic drugs and critically only in emerging markets.
Not the US or Europe.
Nope. Places like India, China, Latin America. It brought in $5.19 billion in 2024 with really solid 9.2% organic growth. Very consistent performer. It was nearly 8% again in Q2 2025.
So their strategy here isn't about finding the next blockbuster drug, with all the huge risks and potential rewards that entails.
Not at all. It's purely about execution. Building strong, trusted local brands, think Creon for digestive issues or Dufistan for women's health. It's about effective marketing, reliable supply chains in those specific regions.
And the strategic role of EPD, why is it so vital?
It diversifies their revenue away from the really intense pricing and reimbursement pressures you see in developed markets like the US and Europe.
Because it's more cash pay in emerging markets.
A lot of it is cash pay or out of pocket. So EPD provides this reliable stream of high-quality free cash flow. And that cash is essential because, guess what? It helps fund those big capital-hungry R&D programs back in the medical devices segment we were just talking about.
Okay. So EPD provides the stability that allows medical devices to accelerate.
Precisely. One funds the other, in a way.
Got it. Okay, fourth pillar, nutrition. This seems like another foundational piece, providing stability. It's split between pediatric Similac, Pediasure, and adult nutrition insurer Glucerna. Generated about $8.4 billion in 2024, 6.4% organic growth.
The numbers look steady, yeah. But the real story here, the thing that truly tested the strength of their brands, was the Sturgis recovery.
Ah, yes, the infant formula recall.
We have to talk about how severe that was. The 2022 voluntary recall and the complete manufacturing shutdown at their big Sturgis, Michigan plant. That was a massive operational crisis. It caused widespread formula shortages, huge reputational risk.
I remember seeing that everywhere. It felt like a crisis few big companies ever face, a huge test of consumer trust.
It really, really was. But what happened next is what shows remarkable brand resilience and, frankly, operational strength. They didn't just weather the storm, they actually managed to recapture their #1 spot in the U.S. infant formula market by 2023.
They got the leadership position back after all that.
They did. And the pediatric business overall posted strong 11.7% organic growth in 2024. That incredibly fast recovery and the growth that followed. It just speaks volumes about the power, the decades of trust built into names like Similac.
That's a critical insight. The fact that parents facing other options and serious supply worries basically went right back to Abbott's brands as soon as they could. It proves that consumer trust is incredibly sticky.
Exactly. That brand equity is a massive competitive advantage. It's durable even when things go terribly wrong operationally.
And while that pediatric recovery is dramatic, the adult nutrition side is more about steady tailwinds, right?
Yeah, products like Ensure and Glucerna, they benefit hugely from that unstoppable demographic trend, the aging global population. As people live longer, the demand for clinically proven nutritional support just keeps rising.
Reliable, non-cyclical demand. Good financial ballast. But we should probably mention, even with a successful recovery, the scrutiny doesn't just disappear.
Absolutely not. The segment is still under the regulatory microscope. There's an FDA warning letter in October 2023 about unapproved claims for their Similac probiotic tri-blend product.
Right.
It's just a constant reminder that in healthcare, even with consumer products, you're operating under extremely strict oversight, always.
Okay, let's pivot to the overall financials then, because all this operational strength we've discussed, it seems to be showing up on the bottom line, particularly with profitability expanding.
Definitely. Adjusted diluted EPS, that grew from $4.44 in 2023 up to $4.67 in 2024. And crucially, management's forecasting double-digit growth for 2025.
And it's not just earnings growth, it's margin expansion too, right? That suggests they're getting more profitable as they grow.
Exactly. That's operating leverage. Management is guiding for an adjusted operating margin between 23.5% and 24.0% for 2025. That's a jump of 150 basis points, or 1.5% from 2024.
And what does that margin jump tell us?
It tells you that the really successful high-margin medical devices segment is increasingly driving the overall sales mix. As devices becomes a bigger piece of the pie, the whole company becomes inherently more profitable for every dollar of revenue earned.
And the underlying profitability metrics look strong too. Things like ROE, ROIC.
Stellar, really. Signals excellent use of capital. You're looking at return on equity, ROE, near 30%. It was 29.93% trailing 12 months. And return on invested capital, ROIC, around 12.58%, though some analysts see that potentially hitting over 20%.
Why is that ROIC number so important for investors?
That sustained high ROIC is really key. It shows that management is very effective at taking shareholder money, corporate capital, and generating superior returns from it. When a company's ROIC is consistently way above its cost of capital, that's a clear sign of long-term value creation. It signals a strong competitive moat.
And as we established, this performance is fueled by that very active R&D pipeline, investing almost $3 billion a year. The pace of new product announcements is pretty staggering. Over 15 new growth opportunities announced in 2024 alone.
Yeah, the output from that R&D spend is tangible, high-value stuff. If you just recap the big wins from 2023 to 2025, the AVR dual-chamber leadless pacemaker FDA approval, the TriClip for the tricuspid valve, the Tendyne device for mitral valve replacement without open heart surgery, the Volt PFA system getting the CE mark in Europe.
Each one validates the investment strategy.
Right. It shows a commitment to being first or best in critical categories.
And besides their own R&D, they use M&A too, but in a specific way. Tuck-in acquisitions.
Yeah, they're very disciplined about it. It's generally not about huge, transformative, risky deals. It's more about buying smaller companies that have complementary technologies, things they can then scale up globally using Abbott's existing sales force and distribution network.
Can you give an example?
Sure. Acquiring Cardiovascular Systems, Inc., CSI, in 2023 added atherectomy systems tools for clearing blocked arteries to their vascular portfolio. or buying Bigfoot Biomedical, also in 2023, which boosts their capabilities in connected diabetes solutions, linking sensors, and insulin delivery. They're strategically buying pieces to enhance their existing strengths.
And all the strong operational and financial management flows through to how they treat shareholders, especially with the dividend. They're a dividend aristocrat, right?
They are. It's a pretty exclusive club. They've increased their dividend for 53 consecutive years. That's incredible consistency. It speaks volumes about their financial discipline and their ability to generate cash reliably through all sorts of economic cycles.
And the increases are meaningful.
Yeah, they raised it again, 7.3% in February 2025 to $0.59 per share quarterly. And it looks sustainable. The payout ratio is only about 47% of their non-GAAP earnings.
So plenty of room for future increases.
It seems like it. Their overall capital allocation philosophy seems pretty clear. First, reinvest heavily in the business, keep that growth flywheel spinning. Second, maintain that growing dividend. Third, use strategic M&A smartly. And fourth, buy back shares when it makes sense.
Okay, let's talk competition and positioning. They definitely benefit from big picture trends, aging populations, rising chronic diseases, more healthcare access in emerging markets.
Huge tailwinds for sure.
But they're up against giants too. Medtronic, Johnson & Johnson, Roche, Danaher. Serious competition.
Absolutely. Well-funded, innovative competitors across the board.
Yet the numbers suggest Abbott is outperforming where it arguably matters most right now.
Yeah.
Organic growth speed, especially in devices.
That's the key point. While their total device revenue, that $19 billion, is smaller than Medtronic's $32 billion or J&J MedTech's $31 billion. Abbott's organic growth in devices, that 13.4%, absolutely blew away its bigger rivals. Medtronic was around 5.2%, J&J at 4.8%.
So they're consistently taking market share.
Yes, sustained industry-leading market share gains in their fastest-growing segment.
And how do they maintain that edge? What are the barriers keeping competitors at bay?
It's a combination of things, that competitive moat. It's the high, consistent R&D spend we keep coming back to. It's the incredibly strict regulatory hurdles that make it hard for smaller players to even enter. It's their large portfolio of patents, intellectual property.
And the switching costs we talked about.
Critically important. Massive customer switching costs, especially in diagnostics with those big lab systems. And don't forget the strong, proven brand loyalty in nutrition, like with Similac, and increasingly in devices, like with Libre. You just can't replicate that kind of trust and infrastructure overnight.
One last financial detail worth flagging, maybe. Management compensation.
Yeah, it's worth noting, their incentives are heavily tied to the stock price, which generally is good, aligns management with shareholders. But the analysis pointed out that share-based compensation was quite high, actually 21.8% of net income in Q1 2025.
So that's something to keep an eye on, potential dilution down the road.
It's just a notable expense line to monitor, yeah. On the flip side, though, you have to remember the assets that don't really show up properly on the balance sheet.
Like what?
Like that deep consumer trust in brands like Ensure or Libre, or the future earning potential baked into that incredibly productive R&D pipeline. Those things provide a layer of hidden value, contributing significantly to their competitive strength and future growth.
Okay, let's try to synthesize all of this complex information. Let's lay out the investment thesis. The arguments for and against Abbott Labs, starting with the bull case. What's the core argument for why this stock might go up?
The bull case really centers almost entirely on the powerful momentum in medical devices. You've got flagship products like Freestyle Libre, TriClip, MitraClip. They're rapidly gaining share in huge markets that still have a lot of room to grow. That points to potentially years more of double-digit growth.
And it's also a story of execution, right?
Absolutely. Management proved they could handle immense pressure. They successfully navigated two massive simultaneous crises, the drop-off in COVID testing and the infant formula recall. That demonstrates exceptional skill at running the organization.
And the diversification helps shield them. The steady, defensive cash flows from EPD and nutrition act as ballast, making the whole company less vulnerable if one area hits a snag, while also funding that innovation pipeline.
Right. Now, the bear case. What are the big risks? It really highlights the challenges of operating in this space. Competition is fierce and getting fiercer across every major category.
Example.
Well, Dexcom is a major force challenging them in CGM. In structural heart, Boston Scientific and Edwards Life Sciences are pushing hard. And that new PFA market for atrial fibrillation, it's filling up SaaS with competitors eager to grab a piece.
So any slowdown in their own innovation, or a misstep in launching a new product,
could quickly erode those market share gains they've been enjoying. There's also that internal challenge we talked about in diagnostics, actually making good on the promise of monetizing that huge installed base.
If they can't convert those machine placements into enough high-margin, non-COVID test sales?
Then that promised tailwind just fizzles out. The investment might not pay off as expected. And of course, regulatory risk is always hovering.
Always a factor in healthcare.
A major product recall, a key clinical trial failing for something like the Volt PFA system, another unexpected FDA warning letter. Any of those could severely damage their reputation, halt sales, and hit the financials hard.
And finally, valuation.
Yeah, you have to acknowledge the market already expects a lot. The stock trades at a premium valuation, a forward PE ratio of around 26, compared to maybe 20 for a peer like J&J.
Meaning?
Meaning if Abbott's growth slows down even just a little bit below what analysts are forecasting, that premium valuation could shrink fast. That's called multiple compression, and it can hurt the stock price even if the company's still doing reasonably well.
Okay, let's touch on some key external risks and how Abbott tries to manage them. Pricing pressure seems constant, especially from governments like Medicare and this thing called VBP in places like China.
Yeah, volume-based procurement, VBP. It's a major headwind, especially in China. Governments basically demand huge price cuts in exchange for guaranteeing they'll buy large volumes of a product like stents or orthopedic implants.
How does Abbott fight that?
Their main weapon is innovation. They have to keep developing truly breakthrough devices, products that offer such clear benefits, better patient outcomes, saving hospitals money in the long run that they can still justify a premium price and secure reimbursement, even with VBP trying to push prices down. It's about demonstrating undeniable value.
And what about operational risk? Like preventing another supply chain disaster similar to the Sturgis recall?
They're tackling that head-on by investing heavily in strengthening their U.S. manufacturing network and making their supply chain more resilient.
Like building new facilities.
It's exactly. They've announced plans for a new cardiovascular device plant in Georgia, and they're putting $500 million into expanding their transfusion diagnostics business in the U.S. The goal is to spread out critical production, enhance reliability, and reduce the chance that one single problem can disrupt global supply again.
And we noted the share-based compensation aligning management with the stock. That also reinforces the focus on that long-term growth flywheel, which is maybe the ultimate protection against short-term issues.
It helps keep everyone focused on the big picture, yes.
Okay, let's bring this deep dive to a close. To sum up, our analysis really confirms that Abbott Labs is successfully managing a really tricky strategic pivot away from those temporary pandemic revenues.
They seem to be navigating it well.
The diversified portfolio is acting like a shield, right? EPD and nutrition provide stability and cash flow. Meanwhile, medical devices driven by game changers like Libre, TrueClip, their PFA system is providing that clear, double-digit growth momentum that really defines their future path.
I think the key takeaways for you, the learner, are really twofold here. First, don't underestimate just how powerful brand resilience can be. We saw that clearly with the nutrition segment's incredibly fast recovery after a major crisis.
That Similac story was impressive.
It really was. And second, you need to look past the short-term financial dip in diagnostics. See the hidden strategic asset there, that massive captive installed base of instruments. It represents a huge multi-year high-margin opportunity that they're really only just starting to tap into.
Okay, so here's a final provocative thought for you to consider, something that might really define Abbott over the next decade. The reality right now is split, isn't it? You've got high-growth, cutting-edge medtech and devices versus these stable, defensive, but slower-growing cash cow businesses in nutrition and EPD.
That's the core tension, yeah.
So given that they are actively pushing into new high-growth areas like consumer wellness with Lingo, advanced medtech like PFA, the big question becomes, do those foundational lower growth segments, EPD and nutrition, remain essential core assets just for financial stability? Or could the desire to become a pure play, high margin innovator eventually make them candidates for divestiture? Could Abbott transform into solely a high growth medtech story?
That tension, that choice between stability and focused acceleration is exactly what the leadership team has to grapple with right now. It's a fascinating strategic crossroads for the future.
We hope this deep dive gave you the structure, the context, and the insights needed to really understand the complexities and the significant opportunities within Abbott Laboratories today.